computer. All right, there we go. Technology is grand, folks. Anyway, good morning to everyone. I am Timothy Yee, Green Retirement, a registered principal offering security and advisory services through Independent Financial Group LLC, IFG, a registered broker dealer and investment advisor, member FIN-SIS, FINRA, SIPC, Green Retirement, Sensiba, IFG are unaffiliated entities. And in all truthfulness, folks, I had one tax class in college. My grades told me that I might not want to pursue tax. And so I am very pleased to welcome 33-year veteran of the industry, CPA Tami Arnold. Folks, the way we're going to run this, Tammy does have a few things she's going to cover. Are there any business owners, anybody who wants to have comments on business tax? If so, give me a thumbs up, pop it in the chat. Otherwise, Tammy is going to be focused primarily on the individual tax code. The one, I really have trouble saying this one beautiful bloated bill, I think is the best I can come up with. That sucker was over 1,500 pages long, and some of the caveats in there, my lordy, not very nice. But anyway, does anybody want us to cover business tax? I am not seeing anyone waving frantically. Tammy, you're okay with questions coming in and James shouting them out, or people raising a digital hand? You're good with that?
Oh, yes, definitely. Yes, definitely.
Okay. All right. Well,
and if I can't answer it, I'll get the information to the person later.
I do have Tammy's contact information, folks, but if you manage to stump the CPA after 33 years in the industry, I will buy you a cold beverage of your choice. I would like to see that. Yeah, I doubt there's very much you haven't seen, Tammy. Okay, Maria has a farm business and just needs to fill out a farm form. So
Okay.
Tammy, just FYI, if there anything in the one big beautiful bloated bill about farms, if you could comment on that. Maria, you may need to clarify the size of your farm because I learned early on in my tax code that a racehorse can be classified as a farm animal, and you get a deduction or a credit. My view is if you can afford a racehorse, you can afford the taxes that go with that horse, and it is not a farm animal. But I digress. Senator Mitt Romney and his wife, who wrote that into the code. All right, Tammy, you don't need me on a political soapbox. Take it away. What are you looking at for 2025 and 2026? And folks, if Tammy doesn't cover it at the end, I will reiterate about beneficiaries and the new higher limit for 401k and 403b plans, as well as the special catch-up provision for anybody making more than 150,000. I don't know if that's in your stuff, Tammy, but I'll throw that in as the 401k guy. The floor is yours, CPA Tami Arnold, Sensiba.
Thank you so much. Let me go ahead and get my slide up here, and hopefully it works. Okay. Get that going.
Let me see. Did I hit the sharing button? Okay, I think sharing is enabled. Yep, no, sharing's enabled.
Okay, so we should be able to get that up. Just let me know if that pops up.
It's looking good. Well, it says it started screen share. Oh, there we go. Perfect. PowerPoint is up.
Okay.
Just need to go to slide view, and away we go.
There we go. Okay, and I'm also going to get my presentation up here as well. So
sounds good.
Get that going. Okay, so just to kind of introduce myself, I'm Tami Arnold. I am a senior tax advisor here, or tax manager in Sensiba company. Just to kind of let you know a little bit about our company, we do a lot of client tax and also accounting services. And I apologize, I'm just trying to get my screen up here. There we go. Okay. Go back. go up here. So just a little bit about Sensiba. We primarily work with tax and audit, assurance compliance. We do tax returns and also financial preparations, audits, reviews. We work on a local basis, but we do have international advising that we can do. We service individuals, businesses, trusts, and estates. And I think Maria had the question with regards to the farm business. I actually do have a special advisor in our Fresno office that can help you. So I'd love to give you in contact, Maria, with filling out that Schedule F. She has a lot of experience in that area. We also do accounting consulting. We specialize in family practices. We do consulting for accounting software, and we've recently added 2 branches to our division, which is related to risk management and assurance, kind of a HIPAA compliance, as well as kind of providing consulting in sustainability. And if you want to get qualified or certified your business in sustainability. I do have to provide some disclosures. So we are going over the One Big Beautiful Bill, and I know Timothy had his own an acronym for that. It was passed in July 4th, 2025. Just some disclaimers that I need to note here. First of all, I'm giving you the information that we have as of today. There is pending legislation, pending cases, pending revisions that will come into effect possibly to impact this bill. We also are looking for continued guidance on some of these provisions, which we'll hopefully get before next tax season. The information I'm providing is just general information. You really should seek the advice of your personal tax professional to advise you how this information applies to your particular situation. And when considering tax strategies, you really want to look at it from consider all aspects, both tax, legal, and financial. And also to the information that we're going to be going through, we're going to be doing it quite quickly, but please note that Timothy does have my contact information, and feel free to always reach out to me if you have any questions.
And we'll be focused on the individual side, folks, unless somebody says differently, even though the OBBB did go quite extensively, I felt, Tammy, into business. We're really going to focus on the individual side.
Correct, definitely. And also, too, understand that I'm providing you information on the federal basis. As I'll note throughout the presentation, you do need to look to see whether your state has conformed to this. So mainly what we're going to be doing is going to be going over just some major legislation highlights for you. Mainly, the OBBA was really to account for some of the changes that were going to go into effect at the end of 2025. So TCJA was one of the major legislations that occurred a few years ago. And a lot of those tax provisions were going to expire at the end of 25. So you'll see that some of what's in the OBBA was to extend those tax provisions or revise them. There are some increases in standard deductions, changes in itemized deductions that we'll go over. I will also talk about some new deductions and enhancement and credits that might be available to you. We'll talk about some things that some new credits that are out there, but also focus a little bit on credits that are now being terminated or suspended. And then talk about some tax planning strategies. Overall, the OBBA extended the tax rates that were to expire at the end of 2025. So TCJA went all the way through 2025. They were set to expire, and we were going to go back to the pre-2018 rates. Really what that meant is, in basic terms, is that we are now at the highest tax rate of 37. It was going to revert back after 2025 to 39.6. We are now going to be as permanent as tax legislation can be. We're going to be at 37 as being the highest tax rate. Also, the tax rates have kind of extended So when you go from one tax bracket to the other, the amount has kind of extended, which allows for a little bit of more tax break for individuals. And then, of course, the married file penalty that was in effect in previous years is now is still fixed and still remains fixed going. There's going to be some impact, so we kind of see that there's going to be potentially a 2.2 reduction in taxes overall after tax rates. This is going to be kind of favorable to maybe higher income tax families, and overall it's going to cause probably a 4.2 trillion budget cost over the next 10 years.
Tammy, when you say higher income, could you just give us what numbers that is? For instance, a tax rate of 37. Who qualifies at that? Is it a person making $1 million, 2 million? Who are the 0.1, just to give our audience a sense on that previous slide?
You're probably looking at over, I would say, starting, I think, at probably 800,000 up above. So that's probably where you're kind of going to be hitting that range.
And for people who are making less than that, would it be fair to say they may see an increase in tax?
I would say that they wouldn't see it. I think their tax rate will kind of stay stagnant as compared to probably the prior years.
Okay, so a stagnant tax rate, but a cut for what most people would argue are the wealthy.
Correct.
Okay.
So I wanted to kind of go over some of the provisions that are going to be for itemized deductions and the standard deduction. The standard deduction is set to increase slightly for joint taxpayers, head of household, and single. I've indicated the amounts for 2025, and those are going to be indexed for inflation going forward. A lot of people are still going to be doing the standard deduction instead of itemizing because the rate is so high. We do see there is a SALT cap, and this was also preventing a lot of people from actually itemizing because your state and local tax is going to be limited to 10,000.
What is the SALT cap? Sorry, Tammy, what's the SALT cap? Being the age I am, SALT was a treaty between the U.S. and the USSR. I know that's not the case. I completely
understand. So it is state and local taxes that you would normally claim on your as an itemized deduction. So this would be state withhold on your 1040. It would be your Schedule A as an itemized deduction.
Okay.
This would be state withholding, property taxes, SDI. That was capped at 10,000. All of those taxes together. That really. For individuals that are paying property taxes, for most of you know, that's going to be more than 10,000 at times. So now they have extended that. So now you can claim up to 40,000. There is a phase out, and I've indicated the phase out here. It will not, though, phase out any less than 10,000. So you still will get 10,000, but you could get upwards of 40,000. And that is set to index for inflation going forward, and I've indicated that there. And then it will, if legislation doesn't change, it will go back to 10,000 in 2030. Itemized deductions.
To that point, then, Tammy, we don't need to rush to Goodwill to donate old toasters and sweaters and try to figure out the value of those, because we're probably going to be not able to donate 15,750 or 31,500. Would that be correct?
Well, correct. But I will give you some benefits going forward with regards to charitable donations. That's going to happen.
Okay, and actually, Rose has a question. Rose, go ahead, please.
Yes.
Hi, Tammy. So
Hi,
for the SALT tax, the state and local taxes, people typically think of it as the taxes that we pay for our homes if we own homes. But what other state and local taxes constitute SALT? Would it include, for example, their vehicle registration tax, or if you own a motorcycle, or if you own a boat, does your Board of Equalization tax count into that if you itemize?
That would be correct, Rose. So it's going to include all local taxes that you would pay, which would include property and DMV fees. Exactly.
But how about sales tax that we pay on consumer goods. So when we go shopping, we know that there's like in San Francisco, I think it's now 9% sales tax. Can you deduct that?
Usually your sales tax, you're going to do sales tax in lieu of state tax. So it's one or the other. And normally your state taxes are going to be much higher. So state withholding that you have on your W-2 is going to be a lot higher than what you do with regards to sales tax. So normally we do not go that route. But you are correct. If you wanted to opt out and just do the sales tax, it creates a lot more paperwork on that end. So, but kind of going back, another thing changing, well, not really changing for itemized deductions. So miscellaneous itemized deductions, this would be unreimbursed employee expenses, investment fees, or also tax preparation fees, like my fee. Those are no longer, they have not been deductible for quite a while. That remains unchanged. However, I do want to make there is a special exception for education. Again, for education, you can do $300 as an above the line deduction. It has nothing to do with itemized. But we're going to see in 2026 that there will be a little an expansion on this to allow educators, because we do know that they spend a ton of money. It will in their classrooms, in work, in supplies, that they will be able to take those expenses as an itemized deduction, but not it will not be subject to the 2% miscellaneous item deduction. So again, for educators, this will definitely be a benefit kind of going forward.
So you're saying the maximum for a teacher to deduct for classroom supplies is 300?
Yes, it's above the line deduction and it's 300. But yes, hopefully for 26, again, you'll be able to those deductions if you itemize, and they will not be subject to a 2% reduction.
Gotcha.
Mortgage interest, again, that is still limited to $750,000 in acquisition debt, meaning if you buy a home over $750,000, some of your mortgage interest can be limited. And that has been permanently extended going forward. Private mortgage insurance premiums were actually expired back in 2021. Now we're going to see for years going forward in 26 that you can treat that as acquisition interest deduction, the insurance premium that you pay, but there is a very, very low phase out period. So this may not impact a lot of people, but I did want to make you aware of that. With regards
on the mortgage interest deduction, given that your company has clients across the U.S., the 750 cap, I mean, the average home price in San Francisco is 1.2, 1.3 million. It seems like it sort of hurts people on the East and West Coast. Is that a fair thing to say?
That is very much a fair thing to say. And a lot of people, and unfortunately, it is lost interest. It's not something that you can carry forward. So yes, it does penalize a lot of people.
So anything above the 750, I can't use it next year.
Yeah, and that's 750 in acquisition debt. So if your debt is 750 and you pay interest, all that interest would be deductible. If you exceed 750 in debt, some of your interest will be limited.
I was just thinking 20% down on a $1.2 million home, you would have nearly $1 million in debt. So,
and some of that would not be deductible. Yeah.
Amazing. Not California friendly, let's just say.
Exactly. With regards to charitable donations, that really hasn't changed for 25, but I will tell you for 26, there are some changes. One is for non-itemized individuals that do not itemize, you will be able to claim an above-the-line deduction for cash donations that you make to public charities, $1,000 for individuals, $2,000 for joint filers. There will be a cap for a 0.5. So if you do itemize, you will have a floor cap of 0.5 of your adjusted gross income for donations that you make. You may be able to carry forward that limit, the amount that was limited to future years, but there are some special limitations to do that. And then now for the 60% AGI gifts, which was set to actually expire at the end of 25, has now been permanently extended.
Tammy, on that, just to make sure, again, I still have nightmares about that exam in tax class, and my grade was not repeatable. So above the line is a tax credit, below the line is a deduction. Is that correct?
So below the line meaning it is not a tax credit.
Okay,
the way that this is going to be, the way this is going to, it's how it affects your adjusted gross income. So this is actually not a credit. Yeah.
Yeah. So
It's
above
just
the line is better. Below the line is a deduction and not as impactful. And how do you prove the $1,000 or $2,000? Do you keep a copy of the check or the credit card statement? How do you prove it in the event of an audit that I did make this cash donation?
really you need an acknowledgement letter from the organization itself. A canceled check or a credit card is not going to be enough to satisfy
Okay.
that actual deduction.
Okay. So good to know.
Yeah, definitely. Just as a last item on here, which was, and this really impacts mainly those that are in the higher tax brackets, is the idea that your overall limitation on itemized deductions. So itemized deductions includes medical expenses, SALT, state and local taxes. It includes mortgage interest, charitable donations. Those in total could be limited. Now for 25, it's not. For 26 going forward, there is a limit on those that are in the higher tax bracket, which is the 37% tax bracket. So I just wanted to kind of note that going forward.
Tammy, a question from the audience. What in the OBBA and in your presentation is impactful to people making less than 100,000? A lot of this seems to be aimed at high earners. What in this presentation or what in OBBA, in your view, is helpful to people who are just grinding it out day in and day out?
You know, I think the only thing we are going to see some benefits in 26, not so much in 25. One of the benefits, of course, is going to be the $1,000 of donations.
Yeah.
There are going to be some credits with regards to child tax credits that are going to be beneficial. I think overall, too, some of the expansions of the flex spending account or the health savings account, as well as the amount you can put into your retirement. Unfortunately, not as much for the low income housing. So I will talk about those items as we kind of go along. Also, too, I want to make you aware, regardless of what tax bracket you're in, if you're making energy improvements or you're buying a vehicle that is part of the clean energy bill, I want to make you aware of when you should be doing that, or if you should have already been doing that, because that does impact people across the board that are not in a particular tax bracket, but are looking to do those efficiency items. So.
I appreciate that. Aaron, to your question, unfortunately, just my view, and the facts seem to bear it out, but this bill seems to be heavily skewed towards the wealthy. That's just my view. And anyway, that I'm not a tax person. Again, I have very bad memories of that instructor handing me my exam. It was not good. Just shook her head and like, geez, Timothy, were you paying attention? Obviously not.
Hopefully in the next slides, there will be some things that will impact people across the board. So I just kind of want to go over those as well. So we do have some new tax and
Tammy,
enhancement.
just real quick. I'm sorry, Tammy, on that clean energy, wasn't that there was like a $7,500 credit for buying an electric car? I think that ended at the end of September. So
yes, so you're correct.
That's sort of all gone. And then I saw us here in California, that clean energy sticker that some people have, no more carpool lane. What, I mean, are you saying go buy a new fridge or? Is
No,
that the
well, I'm
level we're
kind of
at?
saying, well, I'm going to say if you're going to make some of these efficiency credits, well, as far as the clean vehicles, a lot of those, you're correct, did expire in September. For
Hmm.
those that are still looking at solar, you want to make sure that those improvements are made prior to year end, because you do have until the end of this month to
Okay.
do that. So just kind of wanting to make you aware if you're in the process of doing some of these, there are specific expiration
Well, from a
dates.
tax point of view, are you saying contract signed? Because I know when we had solar put on our roof, it was a Rose, I'm sure will correct me, but I think about a 2-year process. So it's not quick by any stretch. So is it
That is
contract
correct.
signed by December 31st?
I will have to look at how they structured you've stumped me, Tim.
Oh,
So
well,
I owe
you can
you a
buy me
call,
a Coke
Brevich.
here.
I owe you a call. I will need to see if that is actually placed in service or contract.
Okay, Rachel
I
has
think it's
just weighed
actually
in.
placed.
Rachel
I
weighed
think it's
in and said it has to be installed, which
exactly.
respectfully, folks, unless you have a magic wand or an inside connection, ours was quite a Pacific Gas and Electric was just not the fastest moving group, I will offer respectfully.
That is correct. That is correct.
And Sam
So
asked about, do all home energy credits expire on January 1st? Are you aware of any home energy credits, Tammy, for after January 1st?
no, they would expire as of December 31st,
All
2025.
right, so all of it. All right, folks, time to go
Or
out and
January
buy
1st, yeah.
yeah, January 1st. So in
Yeah.
case you want to buy a refrigerator on January 1st, I guess that's what I'm hearing. Um,
Right.
yeah. Again, for us working in the trenches, I'm not seeing necessarily a lot of uh, good news, if I may say it that way politely.
Correct.
All
There
right.
are, I mean, I will say on this slide, there probably are a few items that would impact taxpayers across the board. One being, of course, the personal exemption. This would be it's a temporary deduction for seniors, 6,000 for an individual aged 65 and over, 12,000 for married filing joint. There are some phase out provisions with regards to that. It is a new exemption that started this year, 2025. There is some enhancement in the child and dependent care uh, credits as well, moving up to beginning in 26, though this is not 25. In 26, moving up to 50,000. Again, some um, limitations with regards to that credit if your AGI is over a certain limit. The child tax credit is increasing to 2,200 per child, and set for indexing for inflation. Adoption credit is now a refundable credit. It was not refundable in prior years. And then there is one thing with regards to a car loan deduction. This is not an itemized deduction. It's actually a deduction on your return. You up to 10,000 in a deduction on interest that you pay on a new vehicle. It must be used personally. If you have a personal and say business
Oh my.
ownership use of it, you can still apply this towards a business, personal side. Again, there are some max phase outs with regards to your adjusted gross income. The vehicle must be new, U.S. assembled. It can be any type of vehicle, car, van, pickup, but it must be under 14,000 pounds, secured by first lien, and you must be the new owner. And I did indicate a vehicle decoder that the IRS has that you can look to see whether your vehicle.
Yeah, that's helpful because folks, as we were getting into tariff discussions earlier this year, I was surprised at just how many vehicles are made in the U.S. but then shipped across to Canada for parts and back to the U.S. and back and forth it goes. So, what constitute a U.S. assembled vehicle? I think that decoder will be helpful. Andrea, I did find something on the Star Energy, so I popped that in a little article from Scientific American, which does seem to indicate the EPA may terminate the Energy Star program, and some thoughts there. Back to you, Tammy.
No problem. Then, as we kind of mentioned, the things that there are two new items. You do have school choice credit. So what that is if you can claim up to a $1,700 contribution credit for if you actually contribute to a qualified scholarship grant organization in a participating state. There is the new Trump account that is for children to get them going with regards to savings. I've kind of indicated in here, this is something that you can elect to do to start these accounts. They would be started after, of course, July 4th when it came into effect. This is going to be for children born between 2025 and 2028, and the government will kick in $1,000 as a state contribution on that account. And then the distribution rules generally are not allowed until after you reach 18. And as we talked about, a lot of these energy credits for both home improvements and also for vehicles have already terminated as of 9/30/2025, and the home efficiency credits will be expiring mostly by the end of the year. And again, yes, it is placed in service.
And folks, I did pop in an article regarding those accounts. You may have heard about Michael Dell contributing $6.25 billion to fund those accounts, but again, the devil's in the details. I got an article off of PBS that may help give you some insight into that. Again, you would have to have a kid between now and 2028.
Timothy?
Yes, a question, please.
I think the clarification there is that that donation only applies to children who are not covered by this new law, who are already born. And so new law applies to those who are born going forward. And so there's no government money going into those children who are already born. And this seed funds accounts for those who are already born.
Oh, my wordy days. This is, yeah.
Which is great. You know, it puts everybody $250 a head.
Yeah.
But that is the nuance that is so important.
Yeah, I have to agree. Well, it's too bad I can't reclassify 32-year-old James as a 3-year-old, but I guess that's out the window too. Yeah. All righty. Well, back to the individual tax provisions and Aaron's question. For those under 100,000, is there any good news? Tami, I'm hoping this is the slide.
Well, I think there is some things on this slide that might be helpful, or at least for planning opportunities, at least in this and the next slide that I have. We did talk about there's no tax on tips. I just, again, not that I don't know if it would impact this audience, but you may know people that it might impact. There are individuals that are in specific occupations where tipping is customary. They can deduct up to $25,000 in tips. There are some, again, phase out limitations. And also too, the maximum remains at 25. So if you're married filing joint, you're only looking at 25,000 as a tax return, not per individual. And there's no deduction for married filing separate. And there are some special rules for self-employed individuals that receive tips. So I just wanted to make you aware of that.
And the thing on tips, as I understand, Tami, it's going away after the election. November of 26 is my understanding. It's going to go away. And I was talking with one of my servers at a client restaurant, and one night she got $1,000 in tips. Now, yeah, she had some very large parties, but again, $25,000 no tax on tips at 25,000. Imagine in the cities you live, folks, trying to live on $25,000. I would argue not doable. So it looks good on paper, but I'm not feeling it.
It will help individuals that do have partly tips and also other income. So I could see it as potentially not having to include that within their tax.
Does that include like tipping for Uber drivers if somebody has a side hustle on that, Tami? Or is it strictly like the restaurant industry, which is typically where I think of tipping?
If it is, there's specific regulations with regards to this, and I believe it
Uh,
would, you know, I think it's considered as being a customary in that particular industry. So it is possible that that could classify as such.
okay.
Then,
Andrea says it would have covered her roommate or past roommate. Day job was
yeah,
insurance and nighttime. Yeah, I have a friend of mine down in New Orleans who has a variety of gigs, but one of them is bartending. And yeah, tipping is how she makes her money.
exactly.
Mm.
There also is no tax on overtime. Now, I want to kind of specify that this can be up to 12,500 for a single head of household, 25,000 married filing joint. This is considered what is qualified overtime pay. This normally would be for non-exempt employees paid at
Hmm.
least time and a half. I know that people say, well, what about double overtime? We're looking really at the half is really the considered the qualified overtime. So it's not double time. It really is the time, and half is the real premium or the qualified overtime that they're looking at. Again, phase out deductions on this one, and also it's allowed for non-itemized taxpayers, similar to the tax on no tips.
Hmm.
The other items I just kind of wanted to make you aware of, again, the state taxes, not a lot of big changes in this area. The exemption has gone up, which I guess is beneficial to, again, high income taxpayers. But I do want you to make you aware, because a lot of people will maybe help their nephew, whoever out there, or help an individual with, say, medical payments or tuitions. They go, well, do we have to report that as income to the individual? Do we have to claim that, or what do we do? Please note that if you do make tuition or medical expenses, you pay those directly to the facility on the part of an individual. That doesn't really constitute the idea of it is considered an exemption and doesn't impact any type of annual gifting.
Yeah.
Also,
Speaking of gifting, Tammy, two things. Again, I can definitely say giving $19,000 is not something I will be doing, but I did have a client call yesterday where older relatives are looking. So this may not apply to you, but is there anyone, parents, older relatives who may be wanting to do some sort of gifting? And then, okay, Dell, you got your question clarified on gift tax. Good. He was seeing gift tax listed in the lower left and upper right corner and trying to unravel the
all
difference
right,
between
sorry
those
about
two
that.
sections, which don't look at me, Dell. I carry my C proudly from my exam.
But yeah, I will say, again, this may not be applicable to you, but I just want to let you know that if it's under 19,000, there's no issue on reporting. If it's over 19,000, there is some reporting requirements. And if you do have, if you do have a large estate, you may want to consider gifting as part of getting the money out of your estate so you don't have estate taxes. And finally, the RMD, just wanting to make you aware of the change in the age with regards to those that are looking to retire. If you are in a retirement state, you have an IRA, and just consider that you might want to give to, say, your church, and you're over the age of, I believe it's 70 and a half, that you can directly take from your retirement, your IRA, give it directly from your IRA to the qualified nonprofit. That way it is not taxable to you, but you don't get the deduction. Well, that might not matter anyway because you're at the standard deduction. So just kind of maybe consider that too as maybe a gifting option for yourself.
Yeah, and Dell, to that point, they've been raising the RMD. When I started in the industry last century, it was 70 and a half. They've been nudging it up. Now it's going to go to
Yeah.
74. Right now it's at 73. Again, this may be more applicable to parents or older relatives, but I did have a client of mine in Washington who does not need the RMD, doesn't want the tax. And we simply asked her IRA company to cut the check directly to a food bank, which up in Port Townsend, Washington, they are really hurting. I suspect food banks in general across the US. So if you are talking with parents or relatives who are looking for ways to save money, that's one possibility. Bringing it back down, again, I had a client in New York, one of my employees, brand new Bambino, and mom wanted the tax deduction. She's in Virginia. She put money into a 529 plan. In this case, not to give tax advice, Tammy, I think it's 19,000 for the 529, and I'll stop talking about tax. But could fund the 529 up to 19,000. Apparently, Virginia gave her a deduction. But again, you'd have to look, parents or relatives would have to look at their individual state tax code. But it worked out for my employee in New York and for the little kid who got the 529 plan and for mom down in Virginia. So even though the tax strategies may not apply to us because we're not the uber wealthy world, there may be people where it applies. Back to you, Tammy.
And just one point on that 529 plan, there are going to be a lot of changes in 2026 that are expanding it to being able to be utilized at the K-12, I believe, or less.
Really?
So there's going to be some major changes in that area where you'll be able to kind of expand that a little bit more. So if you need some information on that, just let me know. And that will be for 26.
Yeah, and I'll pop a website for you folks in case you are wanting to learn a little bit more about college savings accounts. This is put out by a fellow CPA. I don't know if you know Joe Hurley, Tammy. He's sort of a 529 guy who just absolutely loves that section of tax code. But he rates all the college savings plans around the United States. And obviously, I don't work for Joe or saving for college. Sensiba has nothing to do with him, and my back office has nothing to do with any of this. But he rates all of them. He gives them up to 5 graduation hats, so 5 hats with tassels to say that's the best in his view. Cute, but I like it. Anyway, saving for college, you can check it out if you wish.
So just to kind of give you some tax planning strategies, one is I would definitely review your tax situation, not only for 25, but looking forward to 26, potentially making some changes to your W-2 if your tax situation is going to change. You have, say, an extra dependent, you're getting married, you're retiring, of course, retiring, you won't have a W-2, but some other things to kind of think about, maxing out your retirement. I've kind of indicated on here catch-up provisions for age 50 and above, special catch-up provisions for 60 to 63. You also may want to look at maximizing health contributions to either your FSA, reviewing that, seeing what you can roll over, what you can't. You don't want to lose out on those benefits. Also considering, if possible, if your plan offers an HSA and your situation would allow that, because you would be putting money away. I always consider an HSA as kind of a supplement retirement account because that continues to grow. And you, even if you don't use it, it becomes a tax deduction or a kind of, I would say it works similar to your retirement. You're able to defer that money, at least for federal purposes. I know here in California you can't, but an option for you. Also think about other maximizing of deductions, potentially bulking your deductions into 1 year. I know a lot of you will do standard deduction, but for those that possibly itemize, you may want to, especially for this year, make all your charitable contributions in 25 instead of waiting until 26, because if you're going to get that 0.5% haircut. There's also the impact of, as we talked about, salt, so kind of taking that consideration if you're itemizing. And one thing I want to throw out there, a lot of people think, oh, standard deductions, that's it for me. For federal, I'm good. I don't need that. I don't need to itemize. Well, understand that's for federal. For your state, usually your itemized deductions are much less. And so you may not itemize for federal purposes, but for state purposes, you might have enough to actually itemize, and that might be more of a benefit for you. So don't completely think, oh, I don't need to get all my receipts together. I don't need to care about mortgage interest or charitable donations because federal, I'm not, well, true, but on state, you might. So just kind of take that into consideration.
Just very quickly, folks, again, on the W-2, for those of you who contribute to the Roth retirement plan, I get this question every year. Actually, it comes in two forms. One, do I have a separate document that says my contributions, either pre-tax or Roth? Your W-2 is it. Take a look at your W-2, your Roth contributions, and your pre-tax will be there. Number two, those of you who do your taxes yourself, whether it's a TurboTax, an H&R Block online, the 1040 asks, did you make a contribution to a Roth? If so, how much? Every year I get a panicked call from somebody saying, I contributed too much. Those programs are asking, are you contributing to a Roth IRA? You are not. Your Roth is either a Roth 401k from your employer or a Roth 403b. The maximum contribution to a Roth 401k or 403b in combination with your pre-tax, the maximum this year is $23,500 for those under 50 and $31,000. When the 1040 asks you about a Roth IRA, please do not answer that question. I had an employee in June. We were going over things and she said, yeah, I had to refile because I did my Roth wrong. And she hadn't. And her tax preparer at H&R Block didn't know that. And frankly, Tammy, I didn't know what to say to the person because, again, I'm not a tax advisor, but I'm just like, oh, no, you didn't need to refile. You had done everything right. So please, 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 folks, they're asking about an IRA, which none of you has, through me at least. You may have it elsewhere, but your accounts, Roth 401k, Roth 403b, maximum contribution 23,500 and 31,000, those of us in the 50 and older, and obviously people who are in the 60-63 bracket have even more. And that is correct, Rachel. The Roth is through your job. It's on your W-2. Reminder number two, please keep your beneficiaries up to date as you head into year end, as you think about just financial goals and resolutions. Please check your beneficiary. I had another situation this year where the money went somewhere else than intended. Please, folks, please, please, please check your beneficiaries. If you don't know how to get into your account or if you've forgotten, again, HR will give you the website. There are call centers that will reset your logins, but please verify your beneficiaries. And Tammy, are you going to briefly talk about tax harvesting or should I?
I would go ahead and, if you would like.
Okay, so folks, if any of you have an outside account, a non-IRA, non-retirement account, what I lovingly call a brokerage account, if you are looking to incur losses, if you have stocks or investments that have gone down in value, you might consider, again, if your tax advisor agrees, you might consider selling those, and that can offset some of the gains that you have. So it's called tax harvesting. It's intentionally selling something that has lost to offset gains. Talk with your tax advisor, but it is called tax harvesting. And final point that I'll make, some of you will be asking in the next 4 months, may I have an IRA? The IRS will have what is called phase out limits. And when as Tammy's finishing up, I'll pop the phase out limit link into the website. You may have an IRA depending upon your marital status or your filing status, married, filing, joint, what have you, and your adjusted gross income. You are not guaranteed an IRA. It is maybe you will have an IRA. So I will put the phase out limits in. Tammy, sorry, I had to get my little plug in. Back to you.
No problem. Actually, I'm pretty much done. I have included, just to let you know, in my presentation, just kind of the just be aware of the effective dates on some of these items. Some of them are happening in 25, some of them are happening in 26. There is a lot of information out there, so I just kind of wanted to make people aware of that. And that is pretty much it on my end. Again, if you have any questions, feel free to reach out to me. Timothy has my information. And we can get, if I don't know the answer, I can definitely get in contact with someone that might be able to help.
Alrighty, I am just looking for my phase out limits. Ah, I got it. I had hoped to get it from the IRS website, but it didn't come up, so I'm going to pop in a really long URL from Fidelity. And Kate, I see a question from you. Go ahead, please.
Yeah, I have two questions. So I have a few 401ks. And so in a few years, when I turn 73 or 74, the the required minimum deduction, do I have to do the required from each one of
Nope.
those, or is it the total for the
Total.
total amount? Okay.
Yeah,
That
we
was
total it up. We look at the year you turn 73. We
Mhm,
go back to the previous year, December 31st. We total it up.
mhm.
Then we divide by your life expectancy. And under current law, you are scheduled to die at age 96 and a half, Kate, just to tell you. The IRS said you will. So put it
Okay.
in your appointment book, die here. And
Thank
we
you.
literally divide your year end balance by your life expectancy. And that is the amount you must take out. You can take it from one account, two accounts. Which account do you favor?
Got it. And is that something that I work on with you, or is that
Yep.
something I
Yeah,
figure out
you
on
work
my
on it with me.
own? Okay.
Most of the companies will also put out the number, and I'll say, Kate, this is the minimum. Let's talk about cash flow this year. How
Mhm.
much do you need? And then you might say, I'm going to Tahiti. Okay, we're probably going to blow by the RMD amount.
Right, right. So in relation to that, then, one of
Yeah.
the things I've wondered, because I've got all these different accounts, money all over the place, and I
Yeah.
feel kind of bad for my children when I do die because they're going to have to figure out this and this and this. Do you
Well,
recommend taking all of your 401ks and rolling them into one?
generally, I do, but I look at each one. Let's say you have a 401k that has highly appreciated stock. Kate, you used to work at Apple. I'm making this up. We might need to move that stock out. It may be beneficial to do that. Net
Mhm.
unrealized appreciation. I look at it on a case by case basis, but regardless, even if you have them spread out, what I tell everyone to do is please have very clear directions. My dad has a little black cabinet in his office. Every account has its own little manila folder. Yeah, dad's old school. It has the account number, and in there is a piece of paper. If you have questions about this account, it's at Fidelity. Please call 1-800 Fidelity and say this.
Mhm.
So you
Got it.
make it as clear as you can. So when, we unexpectedly die and somebody comes in, they know what to do. They're marching orders.
Yeah,
So
got
I'm
it.
a big fan of that.
Okay,
Other
then I have
questions?
one more question.
Yeah, go for it, Kate.
And this is about the gifts. So when I've got this money and it's advantageous to my kids, it sounds like, to start giving them more money now so they're not paying estate taxes later on, sounded like. Um, do I, if I give them a gift, do I just write them a check for 10,000 or can I put it into an account for them? Can I create an account and it goes into that? And we own it together and I can just keep throwing money into it.
That's you, Tammy. I'm stepping back.
Mhm.
If you have control over the account, Kate, I don't think it's considered a gift.
Okay,
So
got it.
you have to watch out for that part. You have
Got
to
it.
completely give it over to the individual.
But I could have them make a separate account that's not their checking account, that's more of their savings, and I could just start dumping money in there and then they could just draw from that when they need it.
That
Got
is
it.
correct.
Okay, thank you. That's all I've got. I'll lower my hand.
Thanks, Kate. Other questions, folks, as we head to the final 4 minutes. Here we go from Andrea. Does the gift cover gifts to spendthrift trusts for the benefit of someone? You're up, Tammy. Go ahead and ask
I
your
know,
clarifying questions.
yeah, I'm not sure if I completely understand the question.
And Andrea, if you want to unmute, that way we can make sure we get you the answer you need.
I'm not absolutely sure I need that because I'm not in the position to give that large a gift right now. But if you wanted to give a gift to an individual, and it is only a gift if you no longer have control of it, but you don't want to give it directly to that person, but you want it for that person's benefit, would the, I guess, gift, I don't know how to call it, gift exemption, cover gifts to a trust for the benefit of the person, in addition to gifts directly to the person?
So if a trust is set up for an individual with specifications on when they can start taking distributions, that is considered to be a gift. So it would fall under the gift exclusion amount, because usually your trust is going to be set up, as long as, if you've set it up where, they have kind of control after a certain age, I think that would be correct. It would fall under that exemption. I hope I answered your question, Adrian.
Yes. I was thinking of adult, but never mind. Okay.
Well, we have had adults with special needs, Andrea. I have seen that where, or as one client said to me, I don't trust my adult son with anything. I'm like, okay, this is going to be an awkward conversation. But literally, it was this person may take money out if they've met these requirements. And again, I'm way overstepping my bounds.
But yes, it should work for an adult as well if they have a trust set up for themselves.
All righty. Well, folks, I appreciate this. We will be back on January 8th because if I hold it on January 9th, I think if I hold it on January 2nd, we will all be taking our New Year's hats off. So January 9th, we will be back with First Friday 401k in January. I hope everyone has a wonderful holiday season. Tammy, thank you as always. And folks, do please stay in touch. Be well.
Thank you. Bye-bye.
Thank you, Tammy.
Thank you.